before everybody comes in? This.
It's just focusing. That's all I was doing.
Oh, well, if we could hurry, that'd be great. He's got a flight.
No, I'm good. I'm
Just
good.
B-roll and we're good.
Yeah.
Well, let's make sure it's right before
Right.
we come in. And if you're wondering how, it's called stand-ins, my friend.
Oh, get someone to come in and sit here.
You just sit.
Yeah.
Doesn't have to be my face in particular.
Right. What are you wearing there on your?
That is it's called a Magic Gold Hublot, which I've been straight Rolex guy for a while because they at least hold their value.
Yeah.
I used to be a Hublot guy, but they lose value.
They do, yeah.
Yeah, so like I can't stand it. It's like
It's losing its value, yeah.
But this color shirt and this watch is like flawless. So I'm like, I'm wearing it.
I just bought this Vershawn at the. I just couldn't help it. I'm a watch guy.
Oh, are you?
Yeah.
Well, those are like real watches.
Yeah. One of the Holy Trinity, right? So I've got my AP, just got the Vershawn, and now Patek is the next one to get.
Is that? I thought that was called like a Vacheron.
Vershawn, VC. Yeah.
I never know how to pronounce those.
I think it's Vershawn. Vacheron, I don't know.
Vacheron Constantine.
Right, Vacheron Constantine, yeah.
And Patek Philippe, some people say it's Patek.
Patek, no, I think it's Patek, yeah.
Yeah, I don't have a Patek.
They're hard to get. You have to, I got a relationship with the guy at the watch guy in the Wind now, so.
All I got's Rollies.
Yeah.
And lower.
And
or
Hublot.
Yeah, I mean, I got Breitling, Cartier, but like those are lower than all of them.
Yeah.
No APs, no Pateks.
No VCs. That's the Holy Trinity.
Well, I don't like the Richard Meals.
Yeah.
Yeah, a Patek would be nice. I've just never seen a big one.
They're small. They're like 39 and a half.
I don't like small
dials
watches.
are small. Yeah.
But those are badass. And from what I hear, like that's the nicest of them all. That's just not as popular because nobody knows.
Right. Exactly.
We good?
Listen up or run for cover. Dropping knowledge from the people who have it to the people who need it. The real Brad Lea is dropping
What it is, Brad Lea back again with another episode of Dropping Bombs. Today in the studio, folks, I got a real treat for you, especially if you're in real estate, because we've got Todd Robinson, Esquire.
That's right.
Now, this guy is a real estate attorney, right? Founding managing partner of Robinson, Franzman, and Continental Land Title Company. He's got over $75 million himself in multifamily real estate. Using 100% of OPM. Why do you think it's so important to use other people's money?
Yeah, we were talking about that before. And for me, it's a scaling game, right? I mean, learning how to buy real estate using other people's money, it's how real estate investors scale their portfolio, right? If you've got a finite amount of your own dollars to use, then you can only buy a finite amount of property. But if you're putting in a little bit of your own money and using the rest of OPM, then you have infinite scaling possibilities.
So you're also like as counsel on $5 billion in transactions. So you know what the hell you're doing, basically.
Right. So So I mean, I started my law firm in 2018 with a laptop in my basement and grown it to over 25 staff. And we represent real estate investors in
only.
No, I mean So I've got some partners as well. So a lot of my law firm partners, we do banking. We represent a lot of lenders, real estate investors, corporate work. We've got a litigation team, so we kind of do all of that. But I primarily focus almost 100% of my work on real estate finance and investment transactions.
Just because that's what you enjoy, or
yeah, it's what I enjoy and what I do personally. It's funny. I started out as a litigator when I came out of law school, and I thought I'd be some hotshot trial lawyer, and started doing trial work, and I was doing business litigation, right? Partnership disputes, construction disputes, real estate disputes, and kind of got, bored of just fighting over money and realized that, I thought transactional work would be a lot more interesting. And so just started gravitating towards that and developing a client base in transactional work. At the end of a transaction, everyone's happy, right? You're going to closing dinners, sellers getting their money, buyers getting the property, everyone gets paid. It's a much happier ending than litigation typically.
For sure.
Yeah.
And guys, if you guys want to follow him, he gives away a lot of free content. And the reason why I think it's different than a lot of the gurus in real estate is because not only do you have it, you've done it for billions of dollars worth. So you've seen all the loopholes and the tricks and the issues from a legal perspective, but you're also an attorney.
Right.
And dude, like everyone's going to need a good real estate attorney.
Right.
Who better to have in your fund is the real estate attorney.
Right. Right.
So that's why I think, this one's a little more interesting. Why? Well, because dude, again, all those guys that come on and that do it, they'll hire a guy like you because they don't know necessarily what you need to know, but you do know what they know.
Right. Yeah.
Because you're an investor too.
Right. I'm an investor myself. Yeah, exactly.
So
yeah.
your information, I want to let's give out some stuff that most people wouldn't really know because they're not attorneys. Like, how do you get dicked in a deal through structuring?
That's an interesting question. So it really kind of depends on how you structure it, what kind of deal it is. There's a big difference between a joint venture and a syndication, right?
What is the difference?
So, and I had this conversation with a client yesterday who was buying a deal, and they were only gonna, they were gonna raise $400,000, and they said, "Look, it's just friends and family. It's people I know. It's close relatives. Why do I need to go the SEC syndication route?" And I said, "Listen, the SEC doesn't give a shit if it's just your friends and family. What they care about is, are the individuals that you're taking money from, are they passive or are they active?" So the big difference is the activity level of the member of the company, right? The SEC in 1947 defined what an investment contract is, right? And it's if you're giving me your money and I'm going to go buy real estate and you're going to make a profit based on my efforts, right? I'm going to implement the business plan, the value add strategy. I'm going to sell it for X amount. You're going to make money. That is the definition of a syndication. That requires you to comply with SEC regulations. The workaround is you create a joint venture. A joint venture is when all members of the company are active. So you and 5 of your closest friends go out and buy a piece of real estate. You're each going to invest $200,000, right? It's $1 million purchase. And you're going to structure the entity, the company, so that Brad may be the managing member. But if Brad wants to sell the property or take on a bigger contract or engage a construction company or refinance it, you got to go get approval from your other partners, right? That approval is their activity level, so that then it becomes a joint venture. They're not passive; they're active. So the difference
because you're not the sole decision maker,
right? You're exactly. So in a syndication, investors come in, right? Limited partners come in, and they give you their capital, and they just sit back and they collect their checks, right? They don't do anything. They have no decision-making power at all, right? That is a syndication. And so back in 1933, when the SEC created Regulation D of the Securities Act, they formed that to protect those limited partners, those investors, right? And protect it, meaning when you're doing a syndication, investors, the sponsor has to tell the SEC that they've done this syndication. So it's not like an IPO, right? It's not an initial public offering. It's called a private offering. And a private offering means we just inform the SEC that we've done this offering, right? We've gone out, we bought this property for this much. We have these investors. This is our exemption we're using. And the SEC doesn't question you at all.
Do you have to file it with the SEC if, like, you have a buddy and he's rich, you guys grew up together, and I say, "Man, there's this deal I found, and man, I don't have the money," and he goes, "Well, shit, I'll give you the money,
right?
Just give me a little taste," and I go, "Cool," and he wires me $500,000, and I go give the $500,000. Do I got to register that?
Depending on what the operating agreement says, right? If the operating agreement...
There is no operating agreement. It's just me and my buddy. I mean, like, if they looked,
yeah,
it would look like I own that building.
Right. Then no, you wouldn't have to.
Okay, so it's when there's an operating agreement.
Right.
Now, what if the operating agreement said he owns 10% of the property?
Right.
Period.
And again, it's about decision making. If he owns 10% of the property, but you're the sole decision maker and you can do whatever you want with the property, buy it, sell it, fix it, burn it to the ground if you wanted to, that would be a syndication.
And, I have to, even
Yeah.
if it's just my buddy
Right.
loaning me the money.
Right. So then the question turns to risk, right? What's your level of comfort of risk? So the legal answer is yes, that is a syndication. That's an investment contract. You need to file it with the SEC.
And if you don't, what happens?
The SEC, again, the only time the SEC is going to get involved is if someone notifies them,
If
right?
someone gets pissed.
Right. So your buddy says, Brad, you lost my $500K. I'm upset. You know what? I think, I'm going to call the SEC because they're supposed to protect me. They call the SEC. The SEC opens up an investigation, an enforcement action. And they say, Brad, actually, you should have registered this with the SEC. They could levy fines, penalties. They could bar you from raising capital ever in the future.
Can you go to jail?
Potentially. I mean,
See, that's not, in my opinion, fair because
Right.
there's a lot of people out there, they don't know all these rules. And it's quite possible to have a buddy to say, hey, I'll throw you the couple $100,000. And they just went and did a deal.
right. And that happens all the time.
And now they can go to jail for breaking shit laws they didn't even know they were breaking.
Right.
Like, it doesn't have to be willful intent.
No. I mean, if you are taking the steps to go buy real estate with other people's money, the onus is on you to educate yourself to make sure you're doing it correctly. I mean, there's a saying in the legal profession: ignorance is no defense to the law. Right? You've got to make yourself aware of what these rules and regulations are.
Damn.
Right. Yeah.
Well, again, luckily, I've never borrowed any money to go buy real estate.
Right. Well, and you just brought up a good point. There's a difference between borrowing money and investing money, right? There's a difference between debt and equity. So if you're in your example, your buddy, say he loans you the money, right? And you execute a promissory note. That is not an SEC issue.
So I don't
right?
have to tell the SEC.
No, that is not. That's debt. That's a debt instrument.
Yeah, but so basically, I just whip up an agreement that says, "Hey, you're going to loan me $500,000, and then I'm going to pay you back $600,000
Right.
by this day."
Right. Now,
What if I mention in there that it's for this property, and I give him collateral
right
to the property?
Exactly. So then that's a loan agreement, right?
Okay,
That's,
good.
That's a debtor-creditor relationship. Very different than an equity relationship. But I actually had this conversation with some other clients recently as well. There comes a point in time where, debt can be disguised as a security instrument, right? And the SEC can say just because it's debt doesn't mean it's not a security, right? It has to be, what's the purpose of it, right? If the purpose is to get into business together and to make money and make a profit, that could look more like a security instrument, right? But if the purpose is, you're borrowing money because you need to go buy, a boat or something to use it, then that commercial purpose looks more like a debtor-creditor relationship.
So that's why you should just get an attorney.
Right. Yeah. Get an attorney that knows what they're doing.
Yeah, because you want to know. I
Right.
mean, there's probably a lot of people out there that did something that they probably didn't know not to do,
Right.
And it wasn't willful. It was just
Right. And
ignorance.
everything, it's good when it goes, but if it goes south, that's when the problems can arise, right?
But I mean, how many real estate deals do you see go south? Out of 100 deals, how many go south?
I mean, in this market,
Yeah.
quite a few. I mean, again,
What?
it's hard to put a number on it. I mean, maybe 20%, perhaps.
So
30%.
8 of them went
Yeah.
well, 2 went wrong.
Right.
Big deal.
I mean, it's hard to say, but that's why. But if you're considering investing in someone's deal, there's a lot of things you got to do first before making that step, right?
Well, let's walk through those.
Yeah, you got to look at their track record, right? Show me what deals you've done in the past, right? What are your returns that you've made for your investors in the past? What's your experience level? You got to look at the location, obviously. I mean,
But if you're not in, how do you know if it's a good location?
if you're not in that location.
No, what do you mean? I'm not in real estate. How do I
Yeah.
know if it's a good location?
Well, so you got to look at employment factors, right? For the
It's like a CPA when they say, "There's your taxes. Can I file them?"
right.
I don't know. Can you?
Yeah.
Why are you asking me?
Right. Exactly.
But
yeah.
locations, you just use common sense. Like there's schools, there's
Exactly.
shopping malls.
What's the crime level? Right.
Gotcha.
What's the economic activity? What are the economic drivers? Usually look for cities that have 250,000 people or more, right? Because you want to know what the tenant base is, right? If you go buy a property in the middle of nowhere, where are your tenants going to come from, right? If it's multifamily. So All those factors are going to be important. But the biggest issue is vetting the sponsor, right? Has the sponsor had any lawsuits?
How do you find that out?
Have you ever been sued on a financial obligation? A lot of it's asking them. If you want to do a background check, I guess you could.
Asking them.
Right? I mean,
If
sure
they're-
they'll be like, yeah.
If they're out to dick you, I'm sure they'll just say no.
Right. Yeah. So that's the first step I think LPs need to take when they're vetting sponsors, right? Who are you investing with? What's their track record? And how's the deal structured, right?
You say sponsors. Is that a word?
Sponsor
for
is
it?
kind of a term for the person who goes out and finds the deal, gets it under contract, works with a broker, gets the financing, basically does all the legwork on the front end to close the transaction, right? They go out and they qualify for the loan and they raise
On
capital.
their own?
Well, ideally, right? Unless it's what I call emerging sponsor, someone who doesn't have a track record and wants to learn how to do this. They typically have to partner with an experienced sponsor in order to get that credibility.
Are those called GPs?
GPs, exactly. Yep. So in common terminology in this industry, it's GP, LP. GP are the active members of the company, right? That have, voting rights, control. They make the decisions. And then LPs, limited partners, are the ones who just fund the money.
Who's in a better position legally?
Well, legally, I mean, it's hard to say. I mean, GPs are in control, so I think they're probably in a better position because they just have control of the deal. I mean, a lot of times LPs can have a bigger say-so, but depending on who the LP is, right? And there's a myriad of ways to structure these types of deals in the operating agreement, right? If there's one particular LP that's putting in a large amount of money, they can negotiate for a seat at the GP table, right? They can even negotiate for some voting rights on the GP table.
But if shit hits the fan in any negative way, it's the GPs who are liable.
Right.
Can't be the LPs.
Right,
When
exactly.
is an LP liable for anything?
I mean, they're really not. I mean, they're sort of subject to the whim of the GPs, right? They're trusting the GPs, right? So here's my money. Go out, make a profit at this property. We trust you. Give us our money back, when you sell it or when you refinance.
Can an LP, and I'm sure this is obvious, sue the GP?
Yeah. So that's what usually happens. So when a deal goes south, if a deal goes south, LPs, their money's lost, right? The first thing they will likely do is sue the managers, the GP, for breaches of fiduciary duties.
For screwing it up.
Yeah, you did something wrong. You mismanaged it. You didn't pay attention to this. You didn't look at this issue. You owed us fiduciary duties and you screwed it up. So we're going to come after you to pay us back. So that's typically the first line of defense.
What do you see going wrong with these deals?
So any investor or any GP or sponsor, right? The first thing they'll do a financial model. They'll do an analysis, right? Learning this industry is really just learning the math game and learning how Excel models work, Microsoft Excel models. And what happens is when you put in your income, you put in your expenses, right? You put in what's called a pro forma, meaning right now the property is charging $1,000 a month for rent. Well, if we come in, and you know what, these kitchens are from 1980, right? But if we come in and we modernize these kitchens, we put in a backsplash, we put in granite countertops, recessed lighting, we think we can get $1,500 a month. And the reason why we think that is because the property down the street, that's what they did, and they're getting $1,500 a month, right? So there's your proof. So that process is called your current in-place rents and your pro forma rents. So that's your business plan. I'm going to come in, I'm going to upgrade these units, I'm going to charge higher rent, and when I do that, I'm going to have more NOI, net operating income, and my valuation is going to be higher, right? So what goes wrong is a lot of times sponsors, they don't do the underwriting correctly, or they rely. I mean, you can make the numbers say whatever you want them to say, right? That's why if you're a big LP or if you're considering deal as a GP, you need to do your own underwriting, and you need to do what's called stress testing the deal, meaning, and I'm kind of saying a lot here, but so there are certain assumptions that are in the underwriting, meaning we think the vacancy rate is going to be 10%, right? So out of a 100 unit property, we're budgeting for a 90% occupancy, right? What if the occupancy goes to 50%? Are you still making money, right? What's the plan there? And so a lot of times you'll see sponsors say, well, we think the vacancy rate's 2%, right? So that's an aggressive assumption, right?
That one would be.
Right, exactly.
I wouldn't guess ever that you're going to have half rented. So like 50% occupancy,
That's
someone's managing that shit wrong.
Right. Or it could be a real potential opportunity, right?
Well, if you buying it that way,
Right.
yes.
If you're buying,
but
if you're
like
buying it that way.
if you're a LP in that deal, like I'm looking at the GPs going,
What's going on?
why is half our property not leased?
Right. Exactly.
Rent too high,
Mm-hmm.
condition sucks, terms are poor,
Yep.
location's wrong. Like, what is it?
Right.
Oh, there's crack dealers out in front.
Right.
Right. There's no lights.
Yeah, you didn't
Right?
pay.
It's
You didn't pay
dark.
the utility bill,
Or
right.
it's just dark. You know, it's usually in the shitty neighborhoods you drive by. It's like these scary ass looking apartment complexes. I always think to myself, like, man, if I own that property, I'd just install a bunch of lights and brighten that shit up. Like, why would they leave it? It's already in a bad neighborhood. Now you want it dark too?
Yeah. I'd say, have you ever heard of the broken window theory?
No.
It's like a policing theory from the New York in like the 80s. Or maybe it was some economic theory, New York or Chicago, where basically, you know, you go into neighborhoods like that and all the windows are broken, but there was an economic study done that if you just come in and clean that stuff up, like replace the windows, the people will start turning over, right? You'll start having less crime, basically is what it is. It's less crime. So that, to your point, I mean, there's a lot of curb appeal that you can do for a property just to increase the value that way.
Yeah.
Yeah.
So at the end of the day, it sounds like the game is get your NOI up so the business is worth more.
Exactly. And so the way you analyze, you analyze multifamily properties the same way you analyze a business, right? Your value of the property is directly tied to your NOI.
Well, I go into a building, I say, okay, bam, I got 200 units. I have to now come up with 200 renovated kitchens with your analogy.
Mm-hmm.
Each kitchen's going to cost 10 grand to renovate. Where am I getting the 200,000?
That's a good question. So either from debt or equity. So if it's equity, you're going to raise that money from your investors. That's going to be a part of what's called your capitalization table, right? Your sources and uses. You're going to tell the investors, we need to renovate 200 kitchens. It's 10 grand a piece. What is that? $2 million?
200
or $200,000? Yeah. So
no,
it's
2 million.
2 million, right? Yeah. So that's going to be a part of. So we say to investors, we need X amount for our down payment, X amount for closing costs, and X amount for renovations, right? And that's part of the business plan. But if you give that to us, you know, we're projecting we're going to give you a 25% return.
Okay,
Like that.
so now let's say that was what you did, and turns out those renovations are actually 18,000,
right?
Because parts and material were improperly figured, or you forgot to do the parts or whatever.
Right. Yeah. It happens all the time.
Yeah. So is that the type of shit that goes wrong?
Yep. Construction costs.
So again, how would I know that you did that?
So as an LP, if you're asking these questions, you're going to say, show me the estimates you got from
Wouldn't these
construction
people
companies.
finally go, dude, I don't want your money. Like, don't invest then. Like, God damn, bro.
If someone's going to that level of detail,
Because what you're saying, I'd just say, dude, you're not the right guy.
Right.
Someone else.
Well, there's something to be said for that, right? So I mean, most of the LPs are high net worth individuals that have disposable income that want their money to work for them.
Yeah, they got like $1 million laying around and it's
Right.
not doing anything, so they'll give it to you and they don't care.
Exactly. Right. Doctors, lawyers, business owners. You know, actually, one of my mentees is a construction guy, right? He's a roofer, but he wants to get into multifamily. Doesn't have any money. He's trying to learn the game. I'm teaching him on how to invest in real estate
With no money?
He's got no money, right? He's got enough money to pay for the mentorship program, but he doesn't have enough money to.
But can you teach someone that?
Yeah, 100%.
So if I joined your mentorship program, you can teach me how to start owning apartment buildings with no money.
100%.
And is it guaranteed? Now, I know lawyers say, well, nothing's guaranteed, but I mean, like, in other words, is it real?
Yeah.
Like, no, Brad, you didn't make one phone call, but like obviously you're going to show me how to raise it then.
How to raise it, exactly.
Because again, I think it to myself, back when I was growing up and I could have done something like this, my family wouldn't have had the money.
Mm-hmm.
I didn't know anybody that would have loaned me money for an apartment building.
Right.
Nobody.
Yeah.
So where do you teach somebody that's young,
Right.
not connected, from a blue collar family where they're just not around people with money? Where would they go to get money?
So that's exactly almost the avatar of the guy I'm working with out of Texas, and a lot of it is building up their self-confidence as well. You have to be able to talk to people, right? And you have to be able to market yourself, right? No one's going to do that for you. The first step is you got to get educated. You got to learn you got to learn the lingo. You got to live and breathe it, right? The second step is you got to start telling people that you're doing it, right? And in this age of social media, it's so easy to become an expert in something, right? It just requires...
Or claim you are,
exactly, yeah. It just requires you to post the content, create leads that way. And, there's a saying, the more hands you shake, the more money you make.
Yeah,
right?
Is there?
You've heard that? Have you heard that?
That's a great one.
All right. Another one is, your net work is your net worth. You may have heard that one too, right? I like the hands you shake, more money you make, better.
Thank you.
So the idea is you get out there and you market yourself and you create your real estate investment company. You tell people, this is what I'm doing, right? And then you partner with an experienced person, right? What we call a key principal. Someone that can come in and lend their experience, lend their balance sheet. And then all of a sudden that's your team, right? So then when you're pitching this to investors, you say, well, yes, as a team, we have done this, right? It's not, okay, I'm the experienced guy. I've never done this in my life, but I'm bringing this guy onto my team. You just got to learn how to finesse it a little bit, so to speak.
Now, and what's interesting is you earlier said you're thinking about kind of building this into something even bigger, because it's a great plan where you have high net worth people that have killer credentials and financials that could qualify, but they don't want to do the work. Then you got people that are totally willing to do the work and educated because you're mentoring them, but they don't have the financial ability to carry these deals.
Right.
So if you put those two together, you got to win a chicken dinner.
It's a win-win. Exactly.
Because like it's like co-signing for your son's car.
Right.
He's going to work. He's going to make the payment. Yeah, there's risk because I'm co-signing, but I got the car as equity.
Right.
I got the building as equity.
Yep.
So it's really not that big a deal. I would do something like that.
Yeah, exactly. Yeah. So that kind of light bulb went off in my mentorship, and I have a little community where we have weekly calls, and I'm training these new emerging sponsors on how to grow and scale their real estate portfolio.
As a lawyer.
I'm not engaging in an attorney-client relationship with them.
Yeah, but you have the knowledge.
But I'm leveraging my legal background and experience, right?
Yeah,
exactly.
Well, that's what makes it unique, if you ask me.
Yeah.
Because a lot of these guys that I've listened to, they know how to do it too, but then at some point they go, now you got to get an attorney.
Right.
But you can kind of be their attorney and or advise as an attorney. I think that's just an extra advantage.
Exactly. And so the idea came because I've got my own network of high net worth individuals, investors, family offices that I know either personally or represent, or they're just in my ecosystem. And I had a conversation with a couple of them and said, look, if I can bring you a deal, because I've got the connections with the emerging sponsors as well that actually do have good deals, but they have no money or no backing or no experience. But if I go to my high net worth clients and investors and I say, look, I'll bring you a deal. You sign on as a KP. You don't have to guarantee anything, but you just become a part of the team, the GP team.
What is KP again?
KP stands for key principal.
Key principal.
So from a lending perspective, the lender's going to look at your experience level and who's on the team, and you have to meet certain net worth and liquidity requirements. So I asked one of my high net worth guys, hey, would that be interesting to you? And they were like, absolutely. And then you go and talk, whenever I'm pitching the mentorship to potential mentees, whenever I mention, well, look, I'm going to connect you with a KP that's going to co-sign your deal and sponsor your deal. That's all they want to hear, because for them, that's almost guaranteed success, because they, you either have to have money, hustle, or knowledge to get started, right? If you got money and you're wealthy, you can get started just by co-signing on things, right? If you're the underwriter, the knowledge guy, you can go and underwrite deals in what I call bird dog deals, right? That the guys that have no money are the ones out there on the ground game, meeting with brokers, having relationships, and trying to get the deals in the door, right? But they may not have any money, so they've got to partner with someone that does.
Yeah, and that's probably an unlimited thing as that network grows.
Right. Yeah. 100%.
So I'm asking you questions that I want to know.
Yeah.
So like, for
sure.
example, IRR, internal rate of return, I know that. Cap rate, I know that. What I don't know is how to figure it all. What's the math to figure these things out?
Yeah, so that's the model we talked about earlier. So and again, I don't know the actual equations, right? But the model will do it for you, where you put in your income, your expenses, right? And you get your NOI.
Is that what that is?
Right. Yeah. NOI is.
So if I look at a building and I say, okay, give me your rent roll, and they give it to me, and like maybe there's a bad month. Do I need to look at the year? Do I need to look at the last 3 years?
Yeah. So you get what's called a T12. T is trailing, right? Trailing 12, which is the profit and loss for the last 12 months.
Okay.
To give you an idea, an average, like what is the average NOI over the last 12 months, right? And so, yeah, you just calculate the income minus the expenses, gets your net operating income. But then after that, you got to pay your mortgage. And then after that, so that's your debt service, then you get to the true cash flow number.
On average, though, because next week the water heaters could go out and you had no idea.
Exactly.
So all the rent, that's the income.
That's the income. Yep.
Minus expenses equals your NOI.
Right.
Net operating income.
Right.
Is rent minus expenses.
Yep.
And then to get then minus debt service.
Debt service comes off of that, right?
Off of the NOI.
Off of the NOI.
And then that would obviously be what? Profit?
Profit, true cash flow, right?
Cash flow.
That's your actual cash flow. So from an investor's perspective, that is when you're making distributions to your investors, when you have that cash flow after the debt service.
Okay, good. So now what's that called?
What's that?
How do you figure a cap rate?
So cap rate is capitalization rate, right? And it's really a function of NOI and your valuation, right? I used to not put a lot of stock in cap rates because it's fungible, right? Like if you, whatever price you want to pay for a property, it's affected by the cap rate. So the cap rate is basically, it's purchase price divided by NOI. And that gives you a certain cap rate, right? But cap rates even vary by location, which is interesting. So, we're actually under contract to purchase 52 units in like downtown Buckhead, Atlanta, right? High net worth area. The cap rates there are 5%, right? But a cap rate in, a suburb of Atlanta or a kind of a seedier area of Atlanta, for instance, could be 7 or 8%. It's a function of NOI.
Then what's the IRR?
So IRR is internal rate of return, and it's an interesting metric because it evaluates the deal over a life, like how long you've owned the deal. So there's a velocity component to it, meaning, if you, like we were talking earlier, like you want your money back quickly, right? So if you're
at least the seed money,
sure, yeah. If you're investing in something and you're getting your capital back quickly, your internal rate of return is going to be high, really high, because there's a velocity component to it. And all these metrics, a prudent sponsor has a really well-defined financial model. And all these metrics are in the financial model. And if you mess with one lever, right? So if you decrease the income, well, your distributions are going to go down, right? Like we're in the middle of this deal we're working on in Atlanta, like we're trying to figure out our financing. So we've got quotes from Fannie Mae. We've got bridge loan quotes. The interest rate is fluctuating. The proceeds from the lender is fluctuating. It's a $10.6 million deal, right? But it's in the middle of Atlanta. And so I'm working with bridge lenders currently to figure out what kind of rates they can give me, right? And I'm trying to push them on leverage, right? I want them to give me as many proceeds as I can, because my cost of capital, if you're getting it from a lender, is going to be a lot less than getting it from investors, right? Because you're paying potentially 20% return to an investor, whereas a lender, maybe you're paying 5 or 6%.
Yeah, and then you're on Tycoon magazine.
Oh, yeah. I guess that was Yeah, that was I don't know when that was, but there was a spread on the firm for Tycoon magazine. Yeah, I think that
I
was
like
last
the
year.
I like the word, but I never heard of it.
All
Is
right.
that one of those magazines that just sell you the cover?
I think so. Yeah,
It's
yeah,
funny.
yeah.
So you're growing your social media lately.
I have been.
Are you looking to become like the main dude in the space?
Well, I think I saw I saw an opening because, like you said, a lot of these real estate gurus out there, trainers, educators, they're putting out wrong content, wrong stuff, right? And I actually I've represented a couple people that have joined other groups, gotten really bad information, and I'm here trying to unwind it, right? And so I saw an opening, like you said, leveraging my legal skills and experience and creating a community and mentorship program for real estate investors to really learn the correct way to grow and scale the real estate portfolio
and structure it, not
Yeah.
get snatched.
not get snatched. Not like, for instance, I have a client of mine who got bad advice and ended up raising capital with a bunch of promissory notes, right? So they raised $1 million, but they have, oh no, it was $2 million, but they have 20 promissory notes out there, right? And each one of those investors is a creditor of yours now. Each one of them can sue you for failing to pay the promissory note. You've got default interest, you've got maturity dates, you've got all these things that if they were just invested in a deal as, a syndication, as an equity participant, you wouldn't have all those deadlines out there.
How many deals out of all the deals that are out there do you think are structured incorrectly and people just aren't aware of it?
Yeah, it's hard to say. It's hard to say. It's pretty prevalent though. I mean, the people who know what they're doing, I think, and are hiring competent counsel and are risk adverse are the ones that are doing it correctly. But there's so many people out there that, like you said earlier, hey, it's just my friends and family. I'm raising capital from my neighbor, from my buddy. They're not going to call the SEC. They're not going to, sue me. You just never know. So a lot of times I'm counseling clients and mentees. It's about your level of risk tolerance, right? That's the question. Can you stomach that or not?
Well, I would assume if someone is halfway intelligent, you don't need to worry about whether someone calls the SEC. You should be proactive and just comply with their rules because it
Yeah.
won't matter if they call if you just follow the damn rules.
Right. Well, and this is exactly a good point. And this is why we prepare what's called a PPM, right? It's another
Private
acronym.
placement memorandum.
Private placement memorandum. And that is a big disclosure document, a big cover your ass document. Every time I give this presentation on stage, it's usually PPM CYA is what I say, because that document you give to the investor and you say, look, I can lose your money, man. I may lose it, right? There's construction risk. There's economic risk. The tenant base may turn over. I mean, all these things could go wrong. And there's 20 pages of risk disclosures, right?
Do they have to be accurate or just random general?
Some of them are general and some of them are deal specific, right? Some of them are deal specific.
Yeah, because I mean, the only thing I'm thinking I don't know a lot, but I bet you I could do this. Because I'm a pretty smart guy.
Yeah.
What worries me is the things I don't know. Like you don't know what you don't know.
Right.
So like getting a good deal, doing the math. The math seems to be like
You can figure
as
it out.
long as the math's good, it
Right.
should be a good deal.
Exactly.
But where like I don't know rehab. So like I don't know what those kitchens are going to cost. So now I got to call someone. And if that person came in here and wanted to lowball me and said, "We'll do it for 8," then I'm thinking, okay, and I put that in the pro forma, and then it's 12. Well, shit, I didn't know that.
Right.
Or hey, I think I could raise the rent by $100. Like it's just $100, and then I find out $100 they're moving over
Right.
$100.
Right. Right.
And it's like, why would you move over $100? But they did.
Yeah, because these guys are hand to mouth sometimes.
Yeah, and it's like so it's like, oh shit, what do I do?
Yeah.
Or just a bad element moves into the complex that I wasn't aware
Right.
of, and now people are complaining about the neighbors that are up partying all night.
Yeah.
So who manages the property? Because to me, that's all property management.
Yeah,
isn't
yeah.
it?
So you bring up a good point, and it's the first thing I would say is you got to have the right team, right? You can't.
Do you have your own property management team?
I actually do have a property management company. It's one of my businesses, but we have not used it on the last deal. We're actually trying to sell the company, but yeah. So we have our own property management, but I like using third party property management because then you can really put the screws to them if they're messing up, right? Instead of using your own company.
How do you put the screws to them?
Well, if if they're not pushing rents, if they're not,
What do you mean pushing them?
meaning increasing the rents.
Well, so it's up to them.
Yeah, I mean, it's up to you as the owner, but they should come and bring a marketing plan to you and say, look, the property down the street is charging $1,200. Their property's crap. Ours is much better. I think we can charge $1,200. Great, do it, right? Or run specials, right? We'll give you a 1 month free, but we got to get the occupancy up.
Why don't we just ask for more?
Ask the tenants for more.
No, just ask for more. Yeah, like in other words, if I'm sitting in an apartment and
Yeah.
I signed a lease for $1,100 a month, and it's up in 4 months, and they sent me a letter that said your rent's going up to $1,250.
Right.
I'm not going to move over it.
Right. You would think.
Why not just ask them? Well,
Right.
again, I wouldn't.
Yeah.
I don't think anyone else would, dude. $150 just to move? Like, shit, I'd rather not move.
Right.
I might bitch, I might complain, but I'm not moving over $150 more.
Right. Well,
Now that goes to where, well, dude, you're a different level. Do I want to own C properties,
Right.
B properties, or A properties?
Yep. And then you're getting into your tenant base, right? A lot of these tenant, in the C class properties, it's what we call workforce housing, right? That's kind of a classier name for it than C class. But workforce housing are the housing complexes and the apartment complexes that really cater to the blue collar workers, right?
Well, then what's the D class? Because blue collar workers don't live in shitholes, and I drive some apartments by, and they're shitholes.
Yeah,
They're
Yeah.
shitholes.
yeah,
The curtains are down, the screens are torn out,
Yeah.
nobody's taking care of the place. It's dirty. They got broke down cars out front. People hanging out, looking a little bit criminalistic
shady,
on the
yeah.
porch. Like all the classic signs of a ghetto apartment.
right,
But I also, when I see those, think there's opportunity. Why? Well, because if you could talk that gentleman into pulling up his pants and going back in the house, and you could get that car towed, and you could light it up and replace that grass, and maybe put a park in the middle, because I see the little kids running around.
yeah,
Like, it's just so much easier to fix up.
yeah,
But then you fix it up, and guess what? They can't afford it. That's
Right.
why they're living there.
right.
They
right.
took it not because it didn't have a park. They took
all
it
they could
because
afford.
it's all they could afford. So now you go in there and you're like, shit, at what level's too far in that
Right.
situation? Because I want to be in the situation where it's a guy like blue collar type of worker. He's got a little extra money. He's there because it's not too expensive, but it's
Right.
also not a ghetto.
Yeah, yeah. Well, so the couple issues there. If you're buying a C class property in a C neighborhood, you're not going to make any money on it. You're not going to turn that neighborhood over, right? So when we talked earlier about location, what you're looking for is a C class property in an A or B location, right? That's where it's all been gentrified or developed around you, and then then you got to come in and upgrade this property to these standards. And if people leave, that's okay, because you want to turn over that tenant base, right? That's part of the issue as well. You want to have more B and C class or C and A class tenants come into this property once you upgrade it. So, and again, multifamily is very supply demand driven, right? I mean, everyone is always going to need housing, right? There's always a housing shortage. So if you're, you increase this property from a C class property to a B property, right? You turn over the C tenants because you're increasing rent from $1,000 a month to $1,500 a month. Well, those guys are gone. But guess what? Because supply and demand is as such, you've got people coming in at $1,500 that can afford it.
Well, 1,500, that's quite
That's a big jump.
Yeah.
That's a big jump.
Is that real?
Well, yeah, I mean, the property we're under contract actually for, it's in, like I said, middle of Buckhead, behind the St. Regis, like a developer is developing $1 million condos right next door, right? And there's a little shopping center that sold for like $9 million an acre. So we're seeing huge opportunity. He's renting them out for $1,500, $1,400 a month, $1,600 a month. We can easily get $2,000 a month there, easily. That's actually the value add play in that particular area, because otherwise you're paying $3,000, $4,000 a month for a high rise Class A condo, right?
So real quick, let's say for example, I drive by an apartment pretty decent, and I say, "How much is rent there on average?" And they're like, "Well, it depends if it's 1 bedroom, 2 bedroom,
Yeah.
3 bedroom." Let's just say they're all 2 bedrooms, and they're all 1,400 a month. How do I figure out what that thing's valued or should be valued based on the rent?
Yeah, so you got to get back to the NOI, right? So you got to look at your income. I mean, if they're all $1,400, you can extrapolate.
So there's 100 units, 1,400 a month, so 1.4 million a month your revenue.
Top line revenue, right?
And let's say it usually is about half of
Yeah, you don't want to be any more than 50% of expenses. So say
let's say it's half. So
half.
it's doing 700
in
NOI.
Right?
What's that worth?
Then you got to look at your cap rate in the area. So cap rate, what the fair market value of a property is what a willing buyer and a willing seller will agree on, right? So you have market study and analysis that will show you, well, if your property's here, these properties that are really close to it sold at this cap rate. So that's generally the cap rate we're going to use to value this property that we're talking about.
Okay, so let's say it's at 7.
7 cap. Right. So I got to get my calculator out, but 700,000 times the 7 cap is going to be
4.9 mil.
Yeah, that's going to be your valuation.
So 7 cap is just times 7.
Exactly. Yeah.
So if it was $1 million and it's a 7 cap, 7 million.
Right.
I thought the cap rate you figure out based on the price they're asking.
Well,
and
right.
The,
so
and,
you can.
And the price they're asking is usually, like for businesses, a multiple of earnings.
Right.
So if like, dude, we make $700K in net cash flow.
Right.
And what's that called, by the way? Just cash flow, like after debt service.
So we just call it pure cash flow, right?
Does the industry have a word for it?
Just cash flow, yeah, pure cash flow or just cash flow.
Okay, so the cash flows, let's say 700 grand. Usually, it's worth 3 to 5 times EBITDA.
Yeah,
in business.
EBITDA. Yeah.
So is there any calculation that you can kind of get because how do I know I'm paying too much? How do I know it's a good deal? It should be based on the cash flow, isn't it?
It is. But remember, it's in multifamily, it's before debt service. So, I guess EBITDA is what earnings before interest, taxes, and appreciation, right? So in multifamily, it's just that NOI, the net operating income. That's your main number. Because
that's 1.4.
Right. Well, no, this would be 700,000 because the top line revenue was 1.4. So if it's 700K, you just have to say, what's the cap rate in that area, and then based on that cap rate, it'll give you a valuation. And if you're paying too much, if you're paying lower than
then why wouldn't everybody just look for huge ass cap rates?
Well, exactly. So buyers want higher cap rates,
of course,
right? Sellers want lower cap rates because the lower the cap rate, the higher the price, right? The higher the valuation.
No, no. It don't make no sense.
Well, lower the cap rate,
the lower the price.
No, the higher the price.
How if the NOI 700 grand and a cap rate of 3, that's 2.1 million.
Yeah, I always get confused in my mind on the math, but it's the lower the cap rate typically, the higher the valuation.
I thought the cap rate has something to do with the return. So like the cap rates. I thought the cap rate was figured out based on the price minus the.
Right, it's based on the price, but the price can
and
go.
The price is whatever the owner wants to get for it.
The price can go up and down based on what cap rate you use.
Yeah, but if I own an apartment building, you come to buy it, I don't care about your formulas. I know I've been getting 700 grand and I like it and I want to keep it and you want to buy it. So I'm like, hey, you give me a 10 mil and I'll let you have it. Why? Because, that's, 10 more years worth of my revenue. And if you're willing to pay it, I'll buy it. Is that a 10 cap?
Right. So in your example, and that's why I'm saying I don't put a lot of stock in cap rates. What the main industry that uses cap rates are brokers, because brokers want to know how to value property. But from an investor's perspective, the cap rate doesn't really, it gives you a valuation, but it doesn't necessarily give you like a cash flow analysis, right?
So how do I figure the value? Because I can get everything you're saying. So I walk into a building right now and the old man sitting there, he's tired of it. And I'm like, find out your NOI is 700 grand. So in my mind, I should be able to go like a business.
Yeah.
Because I'll buy businesses.
Right.
I'll give you 3 times earnings. That's fair. This market, your rate 3 times. Now, I also know if that were 10 times that amount, it would be worth 6 times earnings.
Yeah.
So my plan is, hey, let me buy it for 3, raise the revenue, sell it for 6. Same
Right.
thing, but just not
Right.
real estate. So I'm trying to figure out, how do I know if it's a good deal?
Yeah.
So it's $700,000 cap rate. I mean,
NOI.
NOI, and you want 30 million? Nah. Or
Right. Right.
700 NOI, and you want 2 million? Like, that's a good deal.
Yeah.
Just as
That's a huge cap rate,
before
right.
I bother doing all the actual due
Yeah.
diligence, I just want a basic math.
Well, so I bought in my portfolio. I own a portfolio of personal care homes, actually in the senior healthcare industry. So it's like an assisted living facility. These things are cash cows, right? It's. I don't know if you know much about the senior industry, but it's different in the sense that it's not a 50-bed assisted living facility. They're called personal care homes. So it's assisted living care in residential setting, right? So we bought it's a $2 million house, and we have 6 bedrooms, ensuite, and each resident pays, $12,000 to $14,000 per month
Damn.
to live there, right? And so
There's nurses and everything.
yeah, there's CNAs, I have an executive director, and I've got some.
It's an old folks home.
Exactly, it's an old folks home, but it's a cash cow. And so when we bought it, it was $1 million a month, $1 million a year of NOI. And we bought it for, or it was around, maybe it was on $950,000. We bought it for $9.5 million. So that's a 10 cap, right? It was a 10 cap. Great deal, right? So off the bat that
Well,
this.
that's the part I still got to figure out.
This
Why
thing
is that
is-
a great deal? You paid 10 times the net NOI.
Well, because you got to separate yourself from business valuation and real estate valuation, right? It's a different analysis. Like the EBITDA, and that's just a market issue, I think. I mean,
I know, but if you went in there and you got that NOI to double, well, now it's 2 million
Right.
NOI. Is it still a 10 cap? Is it now worth double?
right? It is. So to your point, in one of the properties, the basement is going to be constructed to add 7 more units.
Now, if I called some gurus I know,
Yeah.
would they say, "Yeah, you're full of shit. That ain't how it works," or would they go, "Oh no, you're exactly right"?
Yeah. I mean, that's how the industry analyzes it. So yeah, I mean that doesn't change.
Well, then I don't understand the cap rate still.
Yeah.
I'll figure it out.
Yeah.
I'm gonna go Google, or
Well,
maybe I'll join your mentorship. But you're gonna have to you're gonna have to explain it to me, because the cap rate always what bothers
It's-
me.
it's-
Because
yeah, the
I've seen.
valuation.
I went to start digging in a little bit, and it's like, oh, that's a 7 cap. Well, I thought
What does that mean? Yeah.
I thought the 7 cap was based on the price minus this. So in other words, if someone wanted twice as much money, that wouldn't be a 7 cap. If someone was willing to sell it for way less, that wouldn't be a 7 cap.
Right.
So the cap rate is based on the deal. Like it changes.
It
It's
changes.
It's not a.
It's fungible.
Hey, this neighborhood is an 8 cap.
No. Well, to some extent, there's locations that just based on market and based on sales prices will have different cap rates. So, downtown
sense.
Atlanta, right, or Buckhead, Atlanta is going to be a 5 cap because it's a high demand, high valued area.
Well, the lower the cap rate, the more expensive
Exactly.
it is.
Exactly.
And the lower return you're going to get.
Potentially. Yeah. Potentially.
And that's why the cap rate comes down, because
Right.
it's more expensive. And
Exactly.
you're not going to get as big a return.
Exactly. Yeah. Yeah.
Last one I want to know. Cash on cash.
Mm-hmm.
I've heard it. I understand it kind of. I want to understand it better.
Yeah.
Cash on cash return. How do I figure that out?
So your cash on cash return is how much the return you're making based on the cash that is put in, essentially, And again, it's one of those metrics. And so when you're analyzing deals, you have all these metrics, like what's most important to you, right? Is it cash on cash? Is it IRR? Is it average annual return, right? AAR is another metric, right? So the cash on cash return is literally the return on the actual dollars that you invest, right? So it's kind of a hard number versus IRR has this velocity component, right? So your cash on cash may be low, like the deal we're closing. It's like a 6% cash on cash return, right? But the IRR is a 20% based on our business plan, right? So cash on cash, it just kind of depends on what your appetite is as an investor.
So if I throw in $100,000 and I'm getting $400 a month in cash flow, $400 a month, I put in $100,000. That's not a very good
That's-
cash on cash return.
Yeah, what is that? 400 times 12. What is that? per year?
4,800
40. Yeah, that's a 4.8%
cash on
cash
cash.
on cash return. Yeah.
Is that how you figure that
yeah.
out?
Yeah. Yeah.
I gave you $100,000, and
Well,
and in a year I got back, let's say 5 to make it easy. I got a 5% cash on cash.
Well, yeah, and that's one way to look at it. The cash on cash return is also at like a deal level, not necessarily at an independent LP investor level, right? So what that we were just talking about, that would kind of be the preferred return that an investor would receive. So if it's
well, it is whatever it is, isn't it?
Well,
no
yeah.
one decides that. It's whatever you got is your cash on cash
Right.
return.
yeah, yeah,
So is that right?
that's right. Yeah.
Okay,
Yeah.
so
Yeah.
what kind of cash on cash return should I be looking for? Like, in other words, bro, that's a 6% cash on cash return. That's terrible. Like, you can go get 20 anywhere you look.
Yeah. So, but again, it kind of depends, right? 6 to 8% cash on cash. Obviously, the higher the cash on cash return, the better.
Yeah,
Right.
that's what I'm looking for.
The higher, the better. But you got to look at what the business plan is, because if there's a conversion opportunity, or not conversion opportunity, but a value add opportunity, I mean, right? The example we were talking about earlier about increasing the kitchens, right? The cash on cash return right now, when we buy it, may be X. But once we implement the value add strategy,
Get the rent raised.
and we raise the rents because we're charging higher units because we improve the property, our NOI is going to be higher. Guess what? Your cash on cash is going to be higher in the pro forma, right?
So I want to see the pro forma.
You want to see the pro forma, but you don't want to rely on the pro forma only. You want to know what the in place numbers are, meaning what's the seller's numbers? What are they? If we took this over and we just continued the seller's operations, what would we be getting?
How many people can you mentor, dude? Because like I started calling you and walking through deals, like how much time as a lawyer, what do you get paid an hour?
Yeah, I mean, I my rate's $6.25 an hour as a lawyer.
So is it cheaper
Right.
just to hire you to mentor me?
I mean, yeah, basically, yeah. I mean, yeah. So we would, we have the mentorship program, and I kind of structured that outside of the law firm on purpose because what didn't make sense for people to, obviously it's better for me, but it doesn't make sense for emerging sponsors who want to learn this to go through the law firm. So,
Well, I think there's a lot of people that still want to learn it. I mean, I've been
Yeah.
talking about learning it for years, and,
Right.
and I don't see any slowdown of people wanting to get into this. And there's
Right.
new people turning 18, 19, 20 every single
yeah,
day. And
right.
so that's like, dude, I don't see it going away. In fact, it kind of slowed down a little bit because interest rates, but those
It's
are
coming back.
those are about to start to
Yeah.
come back. So
Yeah.
when the interest rates go down, I think these apartments start to move again, don't they?
That's right, 100%. So,
And then
yeah.
the best part, this will be the last. I know you got a flight. The other thing that bothers me is, or not bothers me, but I'm concerned with, is like the value of the building. Let's say 10 mil. I go in, I raise the rent by $200, and the value goes to 15 mil. But the economy took a shit. Something happened to where it didn't work out, and now the building is only technically worth 4 mil, supposedly.
right.
But the rents are still where they were because someone told me the values of these assets, went down. In some case, 40%.
yeah.
Who cares if the rent didn't?
Right.
Because aren't we buying it for cash flow? I'm not buying it for price.
You're
Like
yeah,
I don't care if it's $1 billion and it's only worth $1. I'm not exiting.
right.
I'm taking the cash flow. So if the cash flow was the same,
yeah.
what do
Yeah.
I care why the value is? What do
Well,
I care unless I'm going to exit? What
Unless
the
you're
value
going to
is?
exit, right? So if you're a buy and hold, you don't really care. You can ride those valuations. You can ride the economic valuations, and
But
not
why would
worry
the
about it.
value go down on an apartment that the rent didn't?
Well, that's a good question. I mean, again, it's a function of interest rates and cap rates, right? When interest rates were really high, cap rates were high, and so sellers, it was good for buyers, but then that's why the market kind of stalled. Buyers, it was good for buyers, but buyers couldn't buy because interest rates were too high. Sellers didn't want to sell because the cap rate wasn't low enough for them to get a good valuation, and so that's where the valuation disconnect came from. And so now we see interest rates kind of getting cut. Valuations are going up, and buyers now interest rates are going lower. So buyers are now coming back to the market to take advantage of those interest rates.
Well, you've been in the market the whole time. How come it didn't slow you down?
I mean, I haven't been, the last thing I bought was in 2018, I think.
Oh, so it did.
Yeah.
you
So
have taken a
I've
break.
this is the first time I bought 59 units in a little town called Milledgeville outside of Atlanta in May of this year. That's the first thing I bought since 2021.
Okay, and how long? How long? Like, is this a 2-year, 3-year, 4-year play?
Yeah.
Usually.
Yeah, because there's a repositioning period. I mean, unless you're again just back in 2020, 21 when rates were like 2 and 3%. I mean, you made money hand over fist just by putting it under contract, right? Because the rates were just so low. But typically, it's a I would say usually 3 to 5 year play, right? When you buy a property and you're repositioning it, it takes a year or two to get it right. There's usually a lot of maintenance requests. There's a lot of, you got to turn units over. You got to get construction crews out there. That takes some time. So
And
you
if
got
a
to be
guy
ready
like
for
me
that.
doesn't want to do that shit,
Yeah.
I just call a property management company. They do all that.
Right. So we don't manage we're not on the boots on the ground managing the deposits and the tenant complaints and things like that. We have a property management third-party manager that does that. Our job is really to manage the manager, right? Manage as asset manager, right? We're managing the manager. We're making sure the property manager's doing their thing.
Are those easy to find?
Property managers? Yeah, but it's funny, they all crap on each other. They all say bad things about each other, at least where I am, my neck of the woods. It's hard to find good ones. It's certainly hard to find good ones. But it's very important to have a really good property manager.
Yeah.
Yeah.
Well, I'm glad you came in. I'm gonna tell everybody. Listen, if you guys need a mentor that knows the legal end of things for damn sure and has 75 million of his own and involved in 5 billion, reach out to him. You go to @syndication expert.
That's right.
Is that right?
That's the Instagram handle. Yeah.
@syndication expert. Obviously, you can use his law firm. What's the law firm?
Yeah, it's Robinson Franzman.
Robinson Franzman, and you're out of Atlanta.
In Atlanta, yeah. But we represent clients around the country.
You got a YouTube channel yet?
We do at Syndication Expert. Yep. In its infancy.
So you guys go check him out. Go follow him. Tell him the Bomb Squad sent you. And if you guys are interested in selling a deal, you got one. They're starting to pick up. He's looking to buy. And how can the Bomb Squad help you?
That's it, man. You've just appreciate the opportunity to be here.
My pleasure.
Yeah,
folks. Get into real estate. It's a good advice. And as a billionaire told me once, the trick is never to sell. Buy and hold. That's what I've been hearing. Tell me what you think in the comments. Until next time, keep it real. He's got a flat. I don't want to.
No, you're good.